Hello, my dear students. I hope you have been doing well. Today we are discussing about ledger. Ledger is second book of accounts. So once you have recorded transactions in journal, now it's time to prepare ledger. Ledger is a classified record consisting of all the transactions of similar nature put together under one head of account is called ledger. This is the second step of accounting cycle. The first step is journal, then the second step after preparation of journal, we prepare ledger, where all the same type of transactions are transferred from journal and together with the respective debit or credit amounts as given in journal. What we do in ledger, we said it's a classified record because all the transactions of similar nature are put together under one head of account. Suppose all the transactions of similar nature related to any title of account, say suppose cash. What we do in ledger, we take all the transactions related to cash from journal and put together under one head of account, create we one account. We give it title cash and we write down all the receipts, payments, debits and credits transactions related to cash on one page. That will be called the ledger of cash. Similarly, we prepare ledger for all titles of accounts in journal, but there is a proper sequence. First, we prepare ledger for current assets, then fixed assets, then current liabilities, then fixed liabilities, then capital, then drawings, and then revenue accounts, and then expenses accounts. This is the sequence in which we prepare ledger. Even after preparation of the ledger, when we prepare trial balance, we also follow the same sequence. First assets, then liabilities, then capital, then revenue, and then expenses. Basically, a ledger has two sides in all its forms. The left side is called debit and right side is called credit, as in case of journal as well. All the titles of accounts having debit balances in journal are also transferred from journal to debit side of ledger. All the accounts having credit amount recorded in journal are transferred in ledger to credit side. The process of transferring transactions titles of accounts from journal to ledger is called posting. So let's see how we are doing that. As we already discussed, first we will take all assets and within that we will first take all current assets, then fixed assets. This is how we prepare ledger. So in assets, we have a proper sequence. First of all assets, we write cash, then other assets. This is the cash. Generally, there are two types of ledger. One is T form of ledger, and other is running balance or self balance form of ledger. We are preparing running balance or self balance form of ledger because it is more convenient as compared to T form of ledger. In running balance form of ledger, you can find out the closing balance after each posting of transactions related to any specific account. But in T form of ledger, you find out the closing balance once you have posted all the transactions related to account, then end of the all transactions related to a particular account, say suppose cash, you find out closing balance. So running balance, as it is also clear from the main name of that type of ledger, running balance means after each transaction this type of ledger gives you balance. So this is the edge that running balance form of ledger has over T form of ledger. So that's why we have prepared running balance or self balance form of ledger, because it's more convenient. So I do advise you to prepare running balance or self balancing form of ledger instead of T form of ledger. This is the ledger of cash. What you are going to do in ledger, first you write down the title of account as we have written here, cash. Then you write down the columns, first column for debt, then second column for explanation, third column for reference, fourth column for debit, fifth column for credit, and last sixth column for balance. In debt, you write down the same date on which all the transactions related to cash incurred on debt date in journal. It can be one transaction just related to cash in journal or maybe more. So in same chronological order, day to day transactions order, you pick transactions from journal, all transactions related to cash from journal, and post it in ledger. All the debit side of cash transactions are posted to debit side of ledger, or the credit side of cash transactions are posted to credit side of ledger. Now we have started to post transactions of cash from journal to ledger. If you can look at your journal, you find out that on October 1 there was a debit cash transaction of 180,000. It means there was receipt of cash for business 180,000. So in journal it was written on debit side. We have also written in ledger on debit side. All the receipts of cash, when cash is received, it is recorded on debit side. When payment of cash is made, cash is decreased, it is recorded on credit side. So on October 1, business has received cash of 180,000. It is recorded on debit side in journal. So we have also recorded here on debit side of ledger. So after this transaction of there will be closing balance same 180,000 on October 1. Now after first column of debt, there is second column explanation. Here you write down the credit title of account in journal given against that cash transaction. From this explanation you can understand the source of that receipt. Means what is the source, what is the title of account against which you have received that cash. From this explanation, on October 1 in journal you will see that on credit side of this transaction, in debit it was written cash debit 180,000, credit James Roberts capital. So we have written here that credit title of account James Roberts capital. Through this cross reference you can understand the purpose of that receipt. Here we have written explanation James Roberts capital. It means now we have understood that we have received that cash from James Roberts, owner of the business. Now debit side amount given in journal we have written on debit side of ledger, credit side nothing of course, and balance remains same 180,000. This is how we post transactions in ledger. Now again on October 1 you will see that there is cash transactions on credit side 360, so we have posted 360 on credit side in ledger. Now in explanation we have written here the debit title of account given in that transaction, which is advertising expense. Here posting 360 in ledger credit side cash, which shows that payment of cash is made. Here that explanation tells you that we have made payment of cash for that advertising expenses. Now when payment is made, cash is recorded on credit side in ledger, then balance is decreased. When cash is posted on debit side, in ledger cash is increased in balance because cash is received. So after October 1 transactions, after deducting last closing balance of 180,000, we deduct 360 payment of cash. Now after October 1, we have closing balance of 179,640. Then again October 3, there is cash payment of 141,000 on credit side of journal. We have posted on debit side of journal 141,000. Again we have given here debit title against that cash credit transaction. It's a land. It means we have purchased land for which we have made payment of 141,000. Now on October 3, after that cash payment for land, the closing balance in ledger is 38,640. Again October 5, there is credit side cash 15,000 in journal, so we have posted here, transferred here credit cash 15,000 for building purchase. Now balance after that payment of 15,000 in ledger is 23,640. Then on October 6, in journal we can see that there is 2250 cash recorded on debit side, so we have posted here 2250 on debit side of ledger. It means we have received cash of 2250. Now on credit side you will see title of account in journal, it's a sales commission earned. It means we have received cash as a revenue of Roberts Real Estate Company, which is titled sales commission earned. Now we have added to the last closing balance 2250. Now closing balance on October 6 is 25,890. On October 20, again there is cash receipt of 1,500 on debit side, so we have posted here from journal to ledger 1,500 on debit side. So we have received cash of accounts receivable. Now closing balance after adding 1,500 to last balance is 27,390 on October 20. Then October 25, there is cash payment of 2,800, which is the James Roberts drawings, means owner has withdrawn amount for personal use. Now closing balance after that cash payment is 24,590. On October 30, we have made payment of cash for accounts payable liability. Now cash is recorded on credit. So cash is decreased by 3,000 from last closing balance of 24,590. Now 24,590 minus 3,000, the closing balance on October 30 in cash ledger is 21,590. On October 30, we have cash on debit side of journal 1000, so it is posted on debit side of ledger 1000. This is the James Roberts capital, means James Roberts has again invested 1000 capital in business. Now closing balance after adding that 1000 is 22,590 in ledger. The last transactions related to cash in journal is salaries expense on October 31st. So there is cash payment of 7,100 for the salaries expense, salaries paid to employees. So cash is deducted from last balance. Now the closing balance on October 31st in cash ledger is 15,490. So this is you can see that here why we said it's a classified record. Now we have classified all the transactions related to cash from journal are transferred or posted to ledger. In journal, if someone asks you quickly that what is the closing balance of cash, say suppose on October 20, you won't be able to tell anyone immediately, because in journal all titles of accounts, all transactions related to all types of accounts are put together. You cannot find out. If someone asks you, tell me all the receipts and payments of cash, all the debit credits related to cash transactions in journal immediately, but you can't tell. But in ledger We classify all the transactions related to each title of account separately. This is the purpose of ledger. That's why we classify accounts in ledger. We find out all the debits and credit transactions related to one title of accounts, and after each transaction we can find out the closing balance. Now at the end of the period you can see that from that ledger the closing balance on October 31st in ledger of cash is 15,490. This is how we prepare running balance or self balance form of ledger. Now, as we have already discussed that first we take cash, current assets, then in current assets, then cash, then after cash we have sequence receivables. Now, if you can see that in ledger, after cash we have receivable title of account, accounts receivable. Now, all the transactions related to accounts receivable are transferred from journal to ledger. We have given title of account accounts receivable. Now in journal you will see that on October 10 there is accounts receivable recorded on debit side 11,000. So we have recorded here 11,000 on debit side. So we have accounts receivable increased 11,000. This is in cross reference and credit side you will find title land, means company has sold land on credit, so that amount of land is receivable. So of course closing balance on October 10 will be 11,000. Again October 20 you will see that on credit side accounts receivable 1,500 is recorded. It means accounts receivable is decreased. So we have received cash. So cash is received. It means receivable is decreased by 1,500. So we have posted 1,500 on credit side as 1,500 given in credit side in journal. So after that October 30 cash, after October 20 credit side posting 1,500. Now accounts receivable closing balance is 9,500. Again on October 20 we have transactions related to accounts receivable. On debit side accounts receivable 8,390. In credit you will find credit title in journal sales commission earned. It means company has earned sales commission revenue of 8,390 which is receivable. So receivable is recorded on debit side in journal and we have transferred in debit side in ledger of accounts receivable. Now after adding 8,390 last closing balance of 9,500, the closing balance in accounts receivable is 17,890. Please keep in mind that all the assets and expenses have debit side closing balances and all the liabilities, revenue and capital have credit side closing balance. So accounts receivable closing balance, last transaction related to accounts receivable is on October 20 in journal. So we have posted it in ledger. Now accounts receivable transactions are over. Closing balance and accounts receivable is 17,890. Now you will see that we have written all current assets. There's no any other current asset. Now we uh, write down fixed assets. We prepare ledger for fixed assets. In fixed assets, first we have to prepare ledger for land, then all other fixed assets. So in land, all transactions related to land, you will see that in October 3, you will see on debit side land title of account and debit side amount 141,000. So in credit side you will see explanation cash, which shows that company has purchased land for cash 141,000. So from debit side 141,000 journal it is transferred to debit side of ledger and land title of accounts 141,000. So closing balance will be 141,000. Then again on October 10 you will find one transactions related to land. On credit side you will see amount 11,000. It means there is sales of land on credit. So title of account in debit in journal is accounts receivable. So we have written same in an explanation accounts receivable. Now credit side, land, it means land is decreased, so closing balance of land will be decreased as land is sold. So last closing balance 141,000 minus 11,000. Now closing balance in land account on October 10 is 130,000. Then after land, fixed assets, we write down other fixed assets such as in sequence. Other fixed asset is building. Now related to building, you will find out debit side transaction on October 5, 36,000. In explanation, you will see that this is part payment in cash and incurred liability accounts payable for remainder. So company has purchased land for rupees 36,000, and 36,000 payment part is made in cash and remaining amount is liability accounts payables. Now closing balance on October 5 is 36,000. There's no other transactions related to the building. So this one transaction is only in journal. So that's why closing balance remains same 36,000. Then after land, there is office equipment. In office equipment, in journal you will find transaction of October 14, debit side office equipment 5,400, and credit you will find out title of account accounts payable. It means company has purchased office equipment on credit. So closing balance on October 14 will be same 5,400 because there is no other transactions related to office equipment in journal. So this is all about the assets. Then once are written, ledger is prepared. For assets, we prepare ledger. For liabilities, in liabilities, first we write down accounts payable. This is the only liability we have in this example. So all the transactions related to accounts payable are now posted. In journal you will see that accounts payable related to first transaction is on October 5, on credit side 21,000. So this is the liability incurred 21,000. In debit side you will find title of account building. It means company has incurred liability for building, purchased building. So closing balance on October 5 will be same 21,000. Again on October 14 you will see that credit side 5,400 in journal which is for the purchase of office equipment. Now adding that liability to last balance 21,000. Now total accounts payable liability closing balance will be 26,400 on October 14. Now again there is accounts payable transactions on October 16, credit side 270. This is the liability incurred for advertising expense. Now adding that to last balance, closing balance of accounts payable on October 16 is 26,670. Now on October 30 you will see that accounts payable 3,000 is recorded on debit side. It means liability is decreased. So amount is paid of accounts payable 3,000. So 3,000 liability accounts payable decrease. So it is recorded on debit side. In journal you will also here post to debit side of ledger. So in credit side you will find out title of account cash payment is made against debt liability. Now after when you write down liability amount, accounts payable amount on debit side, you will deduct from the last closing balance. When you write down on credit side, you will add to last closing balance. Now after deducting 3,000 from last closing balance of 26,670, closing balance is 23,670 on October 30. Then again accounts payable transaction is on October 31st 144 credit side. This is for the telephone expense incurred. Now adding 144 to last closing balance 23,670. The closing balance in accounts payable is 23,840. This is the credit balance closing balance. As we have already discussed, all the assets and expenses have debit closing balance while liabilities have credit closing balance. Then after liability we have Capital James Roberts. Capital related to the first transaction is in October 1 when James Roberts invested cash in the business. So James Roberts capital on credit side is 180,000, which is the closing balance, and in explanation we have written cash. On again on October 30, there is additional investment of 1,000 by the owner. Credit side cash is received in the business. In debit side title of account on October 30 is cash. So in explanation we have written the title of account cash. And credit side 1,000 posted from journal to credit side of ledger. Now closing balance in capital is 181,000. Then after capital we have title of accounts James Roberts drawings. Now drawings related we have only one transaction of October 25. James Roberts returned 2,800. So James Roberts drawings written on debit side in journal. So we have also posted here debit side James Roberts drawings 2,800. So cash is written on credit side in journal. So in explanation we have written cash. So closing balance on October 25 in James Roberts drawings will be 2,800. Now we have written all assets, liabilities and capital. Now it's time to transfer revenues and expenses. Revenue of Roberts Real Estate Company is sales commission, and now all transactions related to sales commission earned are posted in ledger. On October 6, first transactions related to sales commission earned. On credit side, you will see in journal sales commission earned 2,250. Therefore, we have written on credit side of ledger 2,250. Closing balance on October 6 will be 2,250. Now in debit title in journal you will see against debt sales commission and revenues cash. It means company has earned sales commission revenue in cash 2,250. Against sales commission earned revenue transaction is on October 20 in journal. On credit side 8,390. Therefore on in ledger on credit side we have written 8,390. Now adding last revenue credit side 2,250 balance adding 8,390. Now closing balance of revenue on October 20 is 10,640. So company has earned revenue of 8,390. In explanation we have written accounts receivable because company has earned revenue but amount not collected. So this is the only revenue of Roberts Real Estate Company. Now all expenses. First expense written in journal is advertising expense. On October 1 you will see that on debit side there is advertising expense 360. Therefore we have written 360 on debit side of ledger advertising expense. In credit you will find title in journal is cash. So therefore in explanation we have written credit title cash, which shows that company has incurred advertising expense and paid cash 360. Now closing balance on October 1 will be 360. Again advertising expense related transactions we have on October 16. Debit side 270. It means again company has incurred advertising expense but company has not made payment. Therefore in credit in journal you will find that title of account is accounts payable against that transaction of advertising expense. So after adding to last closing balance of 360 270 on October 16, the closing balance of advertising expense, it means total advertising expense incurred is 630. The next expense is salaries expense. On debit side in journal 7,100 on October 31st. Therefore we have written here on debit side of ledger 7,100. So company has incurred salaries expense and paid in cash. Therefore in explanation we have written cash. Closing balance will be 7,100. This is the only transactions related to salaries expense. So last salaries expense is telephone expense. Debit side in journal 144 on October 31st. Therefore in ledger we have written debit side 144. Company has incurred telephone expense but payment is not made. Therefore in credit side in journal there is title of accounts against that transaction accounts payable. Therefore, in explanation we have written accounts payable. So closing balance will be same 144. This is all about the expenses. So once we have written all the ledger title of accounts, please keep in mind that all the assets and expenses have debit closing balances, and all the revenues, liability, and capital have credit closing balances. Now it's time to prepare trial balance. Once you have posted all the transactions, transferred all the transactions from journal to ledger, and closing balances of each title of accounts is derived, then it's time to prepare trial balance. Trial balance is prepared to determine arithmetical accuracy of the accounts that after posting transactions to ledger, all the debits and credit have been posted properly, there is no error. So to find out that, we take closing balances of all titles of accounts and put together in one statement of trial balance. Here again, you have to keep in mind that first we take closing balances of all current assets, then fixed assets, then current liabilities, then fixed liabilities, then capital, then drawing, and then revenues, and then expenses title of accounts. So this is the same sequence in which we have already posted transactions into ledger. Now sequentially you take closing balances of each title of accounts. As first we have taken closing balance of cash in ledger 15,490. As I already told you, all the assets have debit closing balances as well as expenses have debit closing balances, while revenues, capital, and liability have credit closing balances. Now after cash, debit side 15,490, and other asset closing balance accounts receivable, and on debit side 17,890. Then fixed assets, land 130,000, building 36,000, office equipment 5,400. Now all the closing balance of assets are taken from ledger and written on debit side of trial balance. Then liabilities, we have only one liability, accounts payable, credit side 23,814 closing balance. Then James Roberts capital on credit side 181,000, and against that capital drawings of the owner are 2,800 which are written on debit side. Then we have revenue of Roberts Real Estate Company sales commission and revenue closing balance on credit side 10,640. Then all the expenses closing balances are taken from ledger and written on debit side of trial balance. Advertising expense 630, salaries expense 7,100, telephone expense 144. Now you total all the debit and credit amounts. So debit side total is 215,454. Again you will see that credit side total is also 215,454, which shows that debit and credit amounts are equal with each other, which shows that arithmetical accuracy is there. All the debits and credit transactions has been properly posted from journal to ledger. That is the purpose of preparation of trial balance. Trial balance also provides us the basis for preparation of the financial statements, income statement, statement of owner's equity, and balance sheet. So once your trial balance is ready, you can easily prepare financial statements just like income statement, statement of owner's equity, and balance sheet from that trial balance. So that's all about today's lecture. Next we will prepare financial statements from this trial balance. Thank you.